Hi everyone, Paul here with GammaEdge. It is Saturday, the 23rd of April, 2022. I want to take a little bit of time to go over the last couple days in what we're seeing and perhaps offer some insight to what we think is happening here. Before we get started, I'd like everyone just to pause right here, read the fine print. This is important to us and it's important to you. So once you get done reading this, go ahead and advance on. We're going to talk a little bit about the JPMorgan hedged equity funds. As many of you are aware, JPM has 3 hedged funds that are out there. They run for 3 months and then they rebalance with a different structure. They are hedged funds. The largest one that is out there is this one that you see here, the hedged equity fund. 18 billion in size. Fund number 2 is about 5 billion, and hedge fund 3 is about 3 billion. And you can go to this link here and read up more on this. Every 3 months they reset, and the intent here is that you would get into whatever fund you want to that is closest to the time frame that you're trying to make an investment. They all trade basically the same strategy, so it doesn't matter if you get into the bigger one or the others. The overall structure for the JPM's hedge overall structure is what you see here. So this is a profit and loss line. And what we've got here is what they end up doing is they sell a call at some price level, they buy a put, and then they sell a put. This is called a collar, a put collar. And what they do is they pick these 2 strikes with some specificity, and then they sell, they adjust the call up here to pay for this. So this becomes a neutral strategy for them. So as an example, if this was the spot price on this P&L, don't worry about the numbers right now, we'll get into that in a little bit. They would pick a 5% and a 20% below the spot price, and they would adjust to the strikes that are the closest that they can get to. And the bottom line here is then they would try to find within this 3.5 to 5.5 or so area a short call that would pay for the collar that they put on here. The intent here is that when you bring this in with a portfolio that is correlated to this hedging structure, that they're able to participate in some upside. They do have some participation in the downside, at least to 5% below wherever they enter the trade. And then they are relatively flat in this area, and you'll see that here coming up here. But this is a generalized structure. Again, it occurs across all 3 of those funds that I showed earlier. When we do hedge it, it looks something like this. So effectively, if this is spot price at this particular level here, again, 3.5 to 5.5 is the potential upside, and above that, they're flat. They have market exposure in this particular area all the way on down to that minus 5%. So if they got in here or put the hedge on here, they would have visibility to a 5% decrease in the overall SPX. And then they're relatively flat, provided that they are correlated to the SPX, and effectively they are. Down to 20%. Now below 20%, they have full market exposure just like they did here. So the majority of pullbacks are in this range, and therefore they're banking on no major tail events that put them down here. So just recapping here, they do limit their upside 3.5 to 5%. They do have downside exposure from their entry of minus 5, and then they're flat from minus 5 to minus 20. Because there are 3 funds and they expire, they roll them every 3 months, you get into this sequence where you get different expiries occurring, as I showed earlier, every month, at the end of every month. And so we have these structures that are in place right now. Remember that there's a short call that's above us, and then we have the collar, the long put and the short put. And what I've done for you is gone out and I've grabbed the various strikes of where these are located right now. And you can see that the April expiry, which is coming up here actually next week, has these strikes that are associated with it in 9,100 contracts of the SPXW or SPX. That's a large amount of money, of course. The Mays are smaller. This is with fund number 3, and you can see correspondingly that it's smaller in size. But again, the strikes are listed. And then when we take a look at the mothership, this is the March, June, September, December. This is the big one. This is the one that started it all. 44,100 contracts are poised to come off at the end of June here. And here are the strikes that are associated with that. So this is the one we're playing with right now. That's a big deal. And we'll talk a little bit more about that here, as you'll see. I wanted to point out for everyone, though, these contracts are not liquid. They're not going to liquidate these like intra-month. Because of this, they form an underlying structure that we think is hugely significant and that we have to navigate around as traders. We have no choice in this. The dealers have no choice, and they must also navigate the exact same structure. But remember, because the dealer's on the opposite side of all of our option trades, they do it from the opposite side of the table. So understanding this, I think, is where the edge is and why we're even talking about this here tonight. So what I've done is I've expanded that graph from earlier, that P&L graph, and I've thrown on the various strikes that you hear. And you can see it's not exactly flat here, and that's because we've got some different expiries up here. Down here it looks like there's a knee here, but there are some different expiries there too. And then also out here you can see it starts rolling off a little bit, and that's because of the different strikes here and the different magnitudes that you see here. But effectively here at circle 1, this is the short puts, and 9,100 of those are for April are sitting up there that are short. 5,800 that are sitting up there for May, and 44,000 that are short are sitting up there for June. So it's always good to keep track of these, and we do that here at GammaEdge. In the middle here at circle 2, 4270, we've got 9,100. Again, the same structure that you see here and the same structure that you see here, so I won't belabor that. But you can see the different strikes, and then the short calls are sitting up here. Now these lines that you see here are interim dates, and you can see that the black line here is between now and the end of the expiry. That's where the blue will collapse in 68 days. The red line here is June 7th, and the green line is May 16th. And basically this gives us the trajectories of what is happening. So as we get closer and closer to expiry, these are going to approach the blue line from below over in this area. You can see a pivot here, and you can see that we're going to approach circle 2 from above here, and you can see another pivot here. And keeping track of this, we think, is very useful. Many of you may not be aware of the delta exposure of this contract structure, so I want to go back a little bit and just make sure everyone is on the same page here. So what I've got here is a delta exposure example, that goes out for the June 30 Opex. So this is the big mothership of the collar and the short call. And basically, if you go and look at that, you'll see on JPM side they've got a 3620. Which is sitting right here, and they've got the 4285 here and the 4695. And so what that means is that they're short above this area. That's why they have a delta of -1. In this area where they basically have full market exposure, you can see the delta is 0. So as we go through the expiries from the black to the green to the red and eventually to the blue, we will collapse our delta. And then in this area where they've actually got a flat structure but they want to be hedged, that's where they get that -1 or that negative type of delta structure. And then below that, again, they have full market exposure here that you see. So anywhere the delta is 0, there's no hedging capability. Anywhere the delta is largely negative, or what we call limit -1, that structure is giving them some sort of a hedge, either flat or taking them effectively out of the market. So I want everyone to see what a clean picture looks like, and just be aware that when you have no delta or no hedging going on, that you approach zero here, and when you do have delta or hedging going on, you are approaching this -1 limit. So when we take a look at those expiry lines here, it's very, very important to keep track of these as we start looking at these graphs. Now, I have obviously the ability to generate these graphs. There are other broker platforms that look at these. You actually want to see how this pans out. So if you can go into your broker's platform and you can configure it in such a way to start looking at these structures, you probably want to do so. If you don't have that capability, the thing to understand is that depending on the spot price and where we are in here and the days to expiration, as you can see up here, the dealers have to adjust their deltas. And because this is an illiquid structure, the moneyness will matter here. So if they're in this particular area and the delta limits down to zero, then obviously as we get closer and closer to expiry, they're approaching this, and so their delta hedging flows will get smaller and smaller as they approach this, whereas the delta hedging flows will get larger and larger as they approach it from this side. Remember, this is JPM's perspective. This is not the dealer's perspective, and what that means is that the dealer's on the other side of the table. So if JPM is getting more negative, they're getting shorter. The dealers who are on the other side of the table are getting longer, and if that means that in that case, when they're getting longer, for all other things being held constant, to hedge that, they will end up selling. So we get more selling pressure as we get shorter. The dealers get longer. They have to sell to get back to flat. When we take the composite, now this is taking all the existing major trades that are on, you can see that things start getting complicated, that the different expiries and the different deltas, remember we're dealing with right now April, May, and June. When we overlay all of those, that is part of the dominant structure of the SPX right now. And this matters. We feel that this is a fairly significant thing that we all need to pay attention to. So what I've done here is I've taken basically all of the contracts that are associated with JPM, and I've overlaid the deltas here and added everything up, and then put it in context of these dates here. And the black line, remember, is where we are today. And also remember that this 42.71.78 is where we just closed on Friday. The first thing to realize, and this is what I was saying earlier, is that above this 42.70, which is in this zone right here, you can see that the net deltas decrease day over day. We go from this black line to the green line to the red line as DTE comes down. So if we remain above 42.70, dealer exposure, JPM's exposure, but dealer exposure is getting less. The dealer is getting less from the positive side. JPM, who's on the negative side here, is getting less and less. But as soon as we flip over, things change. And so again, we're on this continuation line, this black line right here. But as we stay to the left of this 42.70 line, you can see that we're progressing now. Instead of progressing up from the black to the green to the red above that level, we're now progressing from the black to the green to the red, but below that level, and we're dropping in net deltas. And so the key here for everyone is that when we start getting really below these different levels, whether they be the 42.70, the 42.85-ish, somewhere in that zone, we'll talk a little bit about that. Things get inverse of what they were from the other state. And then finally here, when the spot price crosses one of these major strike levels, dealer adjustments have to shift. And you can see that very plainly here, is that even though we're on this black line, the next one's the green one, and the green one has got a big shift here. So you can imagine that the further we start getting down here, the more rapid we transit from this black line to the green line. Why is that important? Well, the dealer model was getting less and less deltas over here. Now it's getting more and more deltas here. And so the compensation mechanism that everybody has to do is pretty significant. When we take a look, so let me go back here. I've already omitted one thing. So this is from the viewpoint of the June 30th expiry, right? So that's the blue line here. This is where we limit to in the overall June 30th. We can also look at this from the viewpoint of 429, which is this week, this coming week. And this is looking at what are the deltas for that same composite structure, but now looking at it just from where we're going over the next week. And something very, very interesting emerges in that analysis. So the blue line is still what you think it is, but now the blue line is tied to April 29th. And that means all of these other interim lines are the days of the upcoming week. And you can see those here, the 25th, 27th, and 29th. Why this is important is that, again, if we're above that key level that we talked about, we progress from the black to the green to the red, just like we said here, from the black, which is right now, to the green, which is the 25th, to the red, which is the 27th, and finally we collapse into the blue line, and that's the delta exposure for JPM. If we're below that line, you can see how things change, on the other direction. What's really, really key here that we think is a big deal is that on Friday, the closing price was within a point or two of this range of what we call the delta flip for the JPM hedge funds. Remember, this is a huge amount of money that is sitting out there, and that's a big deal. We think that's huge. And so the fact that we didn't get some of the monetization that we were looking for, and the fact that we are now right at this flip line is we're at a crossroads, as you can see here. We think this is fairly significant and forms one of those flip zeros that we talk about within the Discord. So stepping back here, taking a look at this method, there are a few things I want you guys to be aware of. First of all, the moneyness matters. When we talk about moneyness, we're talking about, these are puts, right? These are long puts. And so if we're to the left here, we're in the money, right? So if the price keeps walking down, then these puts would be in the money. And that's a big deal. So moneyness matters. And we think where we are in relation to these large structural pinning points is very, very important. I will say, from my experience, it's incredibly hard to model what we call non-traditional major transactions. So this JPM, they publish it. It's very easy to track, relatively easy to track. There are many, many, many other services out there that will give you flow indications. I subscribe to a few of them, and I will tell you categorically they're terrible. Not bashing anyone. The key to take away is that many times these large non-traditional transactions just simply are not listed, and so you have to get it from other places. So be aware of that. The other thing here is that the structure being discussed is for the next 3 expiries, right? So these are the largest ones. We've got 18 billion, etc., right? So a lot of money tied up in these things. This is important, right? These are the largest illiquid, what we call big rock transactions in the S&P, but there are others, right? There are plenty of other large open interest levels that we don't know if they're short those levels or long those levels, and that matters, as you just saw. So we try to track them manually, but it's very, very difficult, and just be aware that all models are going to be off. It doesn't matter. It's not just our models. It's all models are going to be off because you don't have visibility exactly to what's going on there. The takeaway then is that instead of thinking of these absolute strikes like what we were just talking about, think in distributions around these levels. So the fact that we were within a couple points of these flip zones over the last into the close yesterday, think of it as a distribution, a bell curve, something like that. So if we're close, because of all of the uncertainty that's out there and all the other transactions that are out there, you probably want to just be in the safe zone and think of whatever your thesis is, your trajectory is, that you're probably right, is if you think in a big picture, as opposed to saying, well, I was a penny short of 42.70, therefore it can't be. Nah, I wouldn't go in that direction, right? So you want to think about these distributions and being around them to be able to see this. Lastly, a couple takeaways for you. We've been discussing within the Discord the importance of the underlying and the illiquid structures. We think we saw this yesterday with the 422 behavior. The delta flip in that 42.70, 42.85 may have resulted in the dealers getting longer in delta now that we're on the low side of this, right? And we think that may have forced that downward pressure. We did see some of a relief rally into the close within the last hour, but it failed. And it pulled right back down into where we settled at that 42.71 level. We think that's due to us being right in that flip, that delta flip area. We believe that the addition of puts in combination with this delta flip could explain much of what we saw yesterday. There are other things with Gamma that I didn't get into with this conversation, and we'll do maybe in another video. But suffice to say, the combination of Gamma and Delta with these puts most likely kept us tamped down and on the lower side of the range. So going forward, I want everyone to watch that 42.70, which is the April end of month long put expiry, and then also watch the big mothership at 42.85, which is the June. Remember, these are not liquid. They're not going to be taken off the table midweek or anything like that. They are rolled on the last trading day of the month. Because of this, we see this as the dominant delta wall, the flip zone where the hedging models must flip. And this gets us into a whole nother discussion about gamma positive, gamma negative, et cetera, et cetera. I think it's pretty clear the role of moneyness here and why we keep banging the table about how important moneyness is, even more so than being gamma positive and gamma negative. All right, with that, we'll draw it to a close. If you found this useful, we talk about this stuff and much other stuff, and got a lot of tools over at GammaEdge.us. That'll take you to a sign-up page to get you into our Discord. 14-day free trial, all the tools turned on. Great group of traders. Would urge everyone to come in, at least kick the tires. Introduce yourself and just let us know how you trade and things like that. Follow us on Twitter at GammaEdges. Note the S on the end there. Certainly would appreciate that. And then here, of course, you're watching off of YouTube. You can always get to us, youtube.com. Note the C. I don't know why they put the C in the middle there, but they did with GammaEdge, and you should land right on our channel. If you like today's content, please hit the like button and subscribe to us. Helps us get elevated in the search engines, which will make it easier for you next time. Thanks, everyone. Make it a great weekend, and we'll see you in the Discord.